Hey guys, how's it going? It's Andy. On this channel, I've been a big advocate of buying the dip on the overall stock market and buying it consistently. That's been my strategy for the past couple months, and it's how I'm planning to build wealth going into the future. But I got a comment on one of my last videos talking about the only problem is once a portfolio goes down 40%, then it has to go up 80% just to get back to where it is. If a person has a sizable portfolio, this methodology is just not practical. So in today's video, I wanted to talk about how I set up my portfolio to not have to deal with a situation like this where I have to recover 80% to just get back to even, why we're focusing on buying the dip and why it's so beneficial. And I just want to talk about some of the things that we see on YouTube with other videos, specifically some of the fear mongering that goes along that pushes people away from taking advantage of buying these dips and pushes people towards potentially selling or just fear in general. I'm currently reading a book that talks about a lot of the behavioral psychology that goes behind investment decisions, and I'm going to be making a video talking about that in the future because I think it's really fascinating stuff, and I feel like I don't see enough of these topics discussed on YouTube. It's more of just what stocks to buy, how to find them, and I think it's more important to take a step back, look at how the human body works and why the body is not designed to invest well. That is the whole purpose of this book, is to explain that humans are bad investors. So to get around that, we have to be very deliberate in the way that we plan our investments and have just an investment plan instead of just running blind. So let's talk about why I buy specific stocks. I've talked in the past about returns, that all of my stocks that I pick for my portfolio, and I'll link that video up above right now if you've missed that. But the whole point of buying these stocks is, one, they're going to outperform the overall market, but I think a less appreciated side of these dividend stocks is that they're going to have less of a drawdown than the overall stock market. In the comment that inspired today's video, they talked about the stock market going down 40%. That happens. It hasn't happened in a bit, but it could happen again. These are bear markets, anything that drops the overall stock market more than 20, and we've had between 15 and 20 of them in the history of the stock market. So it's not something that we're going to look at and go, oh, this is never going to happen again. It will happen again. But the reason that we're looking at it is the S&P 500 since 1990 looks like this. We want to take advantage of this. And part of the book that I'm reading about psychology is that humans are really bad at picking when the opportune time is to buy. So when you look at this chart, it's easy to say, oh yeah, you just buy at the bottom and then you ride it up to the top. It's a lot harder to do in practice. So the way that I'm trying to set myself up for success, even if the stock market continues to fall, which has been a huge discussion, is why are you buying right now if the stock market could continue to fall? I'm totally okay with that because I want to talk about some of the stocks and compare them to how they've done in the S&P 500 during the Great Recession. So I'm going to put up some of the stocks that are part of my portfolio. During the Great Recession, this is when we had the housing crisis, things were going crazy, stock market crashed. So with the red and green candles are going to be the S&P 500 for the next couple slides, and the colored lines are going to be the returns of some of the stocks that I own. So when you see the S&P 500, it was down significantly, and it took years for it to recover. This is Johnson & Johnson, one of my favorite dividend stocks out there. As you can see, it had a much lower drawdown. It's being paid dividends during that time, which allows you to continue to buy shares of this fantastic company. And it recovered higher by the time it took for the stock market to actually recover. So in this picture, let's see, by the time the S&P 500 recovered to being up 1.64%, Johnson & Johnson was up 42%. Then you look at something like Nextera Energy, ticker symbol NEE, was up 47.8% during that time. When you have ticker symbol O, was up 122% during that time. And Pepsi, ticker symbol PEP, was up 25.67%. These dividend stocks don't look super attractive when the stock market is chugging along and growing at this crazy rate that we've seen. For people that don't know, we just had the shortest bear market in the history of the stock market with the pandemic-caused crash back in February and March of 2020. But before that, we had the longest bull market in the history of the stock market. So during that time, dividend stocks aren't going to look that great because growth stocks are historically the ones that have taken advantage of these incredible returns of the stock market and has pushed it up significantly over the past decade. That's why stuff like the NASDAQ, which is the tech-heavy index, has done so well. But as the stock market falls, investors go away from growth and go into value. And dividend stocks are one of the best sources of value in the overall market because as the stock market continues to fall, you're going to still get paid out your dividend. The dividend yield is going to continue to go up. And as you buy the dip, which is the whole point of this video, you're going to be buying it at a better yield. There is the whole thing that you got to make sure that the company can pay out the dividend safely, but assuming they can do that, These stocks that I've showed in the past couple slides show that the stocks don't fall as far as the overall market. So you're not going to have this situation where the S&P 500 is down 40%, and so you need your dividend stocks to go up to 80%. The whole point of these dividend stocks is that it's going to limit your maximum drawdown and hopefully be less than the overall market. That's the whole idea. Another thing in that comment that I wanted to point out is that if you have a large amount of wealth buildup, yes, this is probably not the type of investment portfolio that you should be looking at. If wealth preservation is your goal, and based off of the demographics of my channel, based off of the age of people, probably not the case, but I do want to say, as you get closer to retirement age, your investment strategy is going to change. As you're young, I'm 25, I'm trying to build wealth as quickly as possible. That means taking more risks than someone that is 60 and is 5 years away from retirement. This person in their comment brings up a great point that if the stock market falls 40% and you already have a good amount of wealth built up, that's a huge hit. If you need your money within a 5 to 10 year span, you need to be a lot more conservative than if you're not going to be able to need it for 40 years since when I can legally touch my retirement account. So as people get closer to retirement age, you're going to be buying more mutual funds. It's going to limit your downside risk. But let's talk about some of the common mutual funds that you see out there. Mutual funds are something that seems like a great idea, but then when you see the returns of these mutual funds, this is a mutual fund, VTTHX, which is someone that's targeting to retire in 2035. It brings a yield of 1.48%. So your money will be going up, but when you compare it to the US inflation rate that is sitting now at 7.5%, your value of your money is decreasing significantly by the time you retire in 2035. So you have to balance the idea of building wealth versus not losing what you've already built. If you're more than 10 years away from retirement, these drops in the overall market are fantastic opportunities to buy because historically the stock market has recovered, and when it does recover, it usually is more of like a slingshot and less of a limp back to where we started. This is what we've seen. I talked about this in a video back at the beginning of the year, that you can miss out on the top 10 worst days of the stock market during the year and you're going to do pretty well. But if you're missing out on the top 10 best days of the year, that's where all the returns come from these 10 specific days during the year. And selling and being out of the market is a horrible way to take advantage of these fantastic opportunities. So as the stock market falls, you're going to see more and more of these thumbnails about these fear-mongering thumbnails that, oh, the stock market's crashing. Here comes the recession. I sold everything, a stock market bubble. If you believe that, that's fine. Even though I do believe a little bit of that, there's a way to balance out your portfolio to not have as much of a risk as the stock market falls. I've switched almost completely away from growth stocks because that is not the safe place to be right now. That's why I switched to dividend stocks. So I hope that people see these videos on YouTube and they don't get too scared. As long as you have a plan and you're not trading based off your emotions, these small, relative to how the stock market's done in the past 100 years, drops in the overall market are not that big of a deal, and I see them as fantastic buying opportunities, which is why I consistently add every week. I buy on Tuesday mornings without fail. Doesn't matter what the stock market did the night before, doesn't matter what it's going to do the next day. I always buy on Tuesday mornings just because that's how I have it set up. I want to wrap up this video with the returns of the bull market versus the bear markets, because yes, the stock market is going to fall. That is not something that we can avoid. We did a really good job at avoiding it for almost a decade, but the stock market is going to fall. The green on this graph is how much the stock market has gone up during bull markets. You see some big numbers on there. And then, as you can expect, the maximum that you can lose is 100%. So you have some really big losses. You have 36%, 48%, 27, 37, 36, 33%. But when you compare them to the returns that the stock market has seen during those times, you see 295%, you see 100%, you see 582%. Being in the market is the way that you build wealth. Trying to sell and time the market is a great way to minimize your gains and potentially lose money in the stock market that is historically, on average, brought in 10% per year. That 10% means that one year can go up 20% and then down 10% the next year. Averages out to 10%. Keeping your money in the market is how we build wealth. Trying to time the market is a horrible way to try to build wealth for the future. So this was a video that was kind of bugging me for a while. I had a really busy week at work, so I've had to push it off until the end of the week. But I really wanted to talk about this topic as the stock market continues to fall. I see this as a fantastic buying opportunity, not something to be worried about, especially if you've moved money out of riskier investments, stuff like growth stocks, and have done similar things to what I've done, I think dividends are going to be the way to go for at least the next year. So thanks for watching this video. Let me know what you thought about my discussion about risk versus reward in the overall stock market and the fear mongering that goes on with some of the thumbnails that you see on YouTube. If you made it this far, I really appreciate it if you hit that like and subscribe button, and I will see you in the next video. Thanks for watching.